very promising money market on Starknet. Yes, I'll pass it to Jen and Brian to sort of talk about the project and then follow up with a Q&A for this.
Great. Thanks a lot, Brian. I guess I'll introduce myself first while I pull up the deck in a second. So nice to meet you guys. I'm Jane. I'm one of the co-founders and co-project leads of zkLend. So my role in zkLend is really to lead the DeFi side of our protocol, which is Artemis, really thinking about kind of the logistics and the operations of the entire protocol, because my background does come from Web 2 and operations. So excited to be here to share with you guys more on the project.
Hi, everyone. It's Brian here. Pleasure to meet you all. My background is in a traditional finance and banking world. So my role is also a co-founder and co-project lead in the project, and we'll be focusing more on the institutional side effort and pushing out Apollo side, the permission user side. Very happy to be speaking on the project with you guys, and look forward.
So hi everyone, my name's Emma. I'm the CMO of zkLend. So I'll be responsible for a lot of the marketing, especially on the DeFi side, the go-to-market strategy, and the community building. My background has always been kind of blockchain, digital assets. That's my background. So it's really great to be here to talk to everyone about it.
Thank you, guys. Thank you for joining. Look forward to the presentation.
Jane, I think you're on mute.
And with that, let me directly go into the presentation. So the way we're going to structure this presentation for the next 10 to 15 minutes is really going over kind of our investment thesis, and then more on the product of zkLend, as well as some technical features. And then last but not least, we can end with team, roadmap, as well as, I guess, a little bit more on tokenomics. So to start out on kind of our investment thesis, we actually are betting on two things. First is we believe Ethereum security is exceptional, and we are ETH maxis really. We think that the other chains have been great in bringing about scalability in the long run, but at the same time, we think that Ethereum is really the truly decentralized and secure option made for the purposes of DeFi. The second point I want to make here is Ethereum is like the OG for DeFi, right? So be on layer 1 or layer 2, we think that the ecosystem will always be thriving. Second point we want to make here is we believe the future is institutional. If we look at some of the stats, currently over 60% of DeFi transactions are greater than 10 million US dollars. So if you actually think about, there are a couple whales out there, but you can pretty much assume that most of these do come from institutions. So as retail money tops out, we think this is actually a great thing for the space because, institutional money equals capital to go out to DC and actually clarify a lot of the regulatory landscape. And this will ultimately benefit retail users as well. So we think that this will eventually shape and mold into this new brand of DeFi, institutional DeFi. You can call it DeFi Plus if you like. That will basically bring about kind of the next chapter for DeFi. Great. And so with these ideas in mind, we are starting zkLend. So zkLend is a money market protocol, and we have two types of participants. We have the borrowers who stake their assets to borrow, and then we have the lenders who deposit their assets to earn a yield. Now, since we're starting out with over-collateralized loans on the unpermissioned side, the two are not mutually exclusive. So you can actually borrow and earn a yield at the same time on your collateral. Second point I want to make here is zkLend is actually the name of our project, but we actually have two protocols underneath it, Artemis and Apollo. So Artemis is the little deer over in purple, and Apollo is the swan over there. But Artemis is really our unpermissioned protocol, and here we are targeting DeFi users. So anyone with an internet connection would be able to borrow and lend on Artemis. Apollo, on the other hand, is permissioned, and here our target audience are institutions. Institutions basically need to go through a KYC check before they're actually able to enter into the protocol or get whitelisted, so to speak, so that they can actually interact with other whitelisted institutions on the same protocol. So starting out, we do expect the capital pools of the two to be separated, but happy to talk more about kind of ideas that we have and later synergies that we're thinking about as well. And then last but not least, want to highlight here that we are going into deep tech here with the Starknet folks, since we will be utilizing ZK rollups and Starknet as the layer 2 execution layer. And I think one of the things to point out about StarkNet is it's not EVM compatible. So it's not like you can just fork code and copy and paste things over, but you literally need to write everything from scratch. So Jonathan, who is our tech lead, has actually already begun the building process. And we're pretty certain that we're going to be the first money market protocol to go to market with StarkNet. Great. So with that, let me just go through kind of our business architecture very quickly on the Artemis side before passing on to Brian. So Artemis, the unpermissioned protocol, what are kind of our selling points, right? I would say there are 3 parts to it. First and foremost, we're going to be cost effective and fast. Gas fees will be 0.1% of what it used to be, while transaction throughput can hit 3,000 transactions per second. I really like to use this analogy, and apologies for those who are very familiar with StarkNet already, but I like to think of it as, you could call an Uber, take an Uber to work and like pay $80 and get there in like 30 minutes because the traffic is really bad. Or you can actually like take a bus that picks you up on the same spot, gets you there under 5 minutes, pay 1/10 of the cost, and all is well, right? So if you think about it, StarkNet and Ethereum, these are kind of the analogies I am making, except that these numbers that I just pointed out, 3,000 and 0.1%, these are numbers that have actually been proven in the past with StarkX in existence. So the immutable X's and the DYDX's that came about a couple of months ago. We know that these efficiency numbers are true. Second point I want to make here is you don't have to trade off decentralization and security like you do on the other chains. StarkNet inherits a lot of the security features of Ethereum. And in particular, the one I want to point out is called an escape hatch method, which basically enables users to retrieve their funds on layer 1 if StarkNet were to disappear overnight. And then last but not least, in terms of the money market protocol bit, I think we are inspired by Aave and Compound, but we are looking to iterate on previous generations of money market protocols. After all, money markets are kind of like the building blocks of any financial system. And we think that in the DeFi space, it's still pretty much in its infancy. So here, really what I'm referring to are how do we play around with capital efficiency by looking at the different interest rate curves, loan to value ratio, or even different asset tiers. Yeah, so I think with that, I'll just pause right here and really just summarize very quickly what I just talked about, which is, we have a first mover advantage on StarkNet, but beyond that, we really see ourselves as a leading money market protocol across different layers, and pushing the boundaries in terms of the types of product features that we're going to be able to offer. Great, Brian.
Sure. I'm going to cover the institutional side of things for this protocol, the Apollo. Apollo will cover institutional client, which means we'll cover the traditional FIs, meaning banks, investment companies, hedge funds, VCs, and we'll also cover the second bunch of institutional users, such as family offices, corporate treasury of SMEs and private companies. The reason we want to include the second bunch is because, one, it's not currently very widely explored in the space. There are great, huge market potential for this type of clients. And two, we are seeing that for financial institutions, there are a lot of regulations hurdle coming up, and their adoption rate are actually starting to flatten off, even though the initial adoption rate is very fast. I want to highlight 3 key components for Apollo. The first one being KYC. Apollo is very compliant focused. All the lenders and users will have to be KYC, and they'll be KYC in the different tiers by countries, jurisdiction, legal system, and the type of business they're in. And also we'll incorporate an on-chain and off-chain KYC structure, where off-chain they'll do background checks and reference check, and on-chain we will incorporate custodians and whitelister to help monitor the money flow on-chain. Secondly, the channel of borrowing will be divided into 2 chains. One, it's collateral, and the other one is under collateral or uncollateral. The collateral chain will comprise of a commingled pool where lenders and borrowers will pull into a single fund, will pull into a single liquidity pool, and they'll be lending and borrowing against each other, and they'll directly and indirectly know who the other party is. For uncollateralized channel, it will be a peer-to-peer lending process where borrower will be matched with a lender on a one or multiple process, and they will effectively know the identity of the borrower, and also they will know the credit profile and also the term of the loan and they'll be able to take on additional risk for additional return. Lastly, Apollo is very high touch and client engagement, very high client engagement. We will employ institutional sales to help with the onboarding process and after sales. The core function of it is to understand the client needs and to being able to provide the handholding process for onboarding and also the after sales. And with that, we're able to provide the traditional front office experience with the DeFi technology side of things and making it a hybrid product for Apollo. So Apollo, the three key components are: 1, KYC; 2, there are two channel of borrowing; and 3, it is very high touch. In terms of the product feature, I'm not going to repeat all the product feature that's on the slide right now. But one thing I do want to just give me 1 second. Jane, could you help me move 1 slide, please? Yeah, thank you.
Yeah, is it showing up? Sorry, there might be a little bit of a delay.
No, that's fine. That's fine. For the product feature, I'm not going to cover all of them because basically these. If you have any further questions on this, we can cover it in the Q&A. But one thing I do want to highlight that is we do want to cover long tail assets gradually. While we will start with the short tail assets, and for the long tail assets, we will start introducing asset tier where we'll have high risk, medium risk, and low risk tier. And for the low risk tier, those ones will be able to do collateral and then lend against all the other assets. Whereas on the other end of the spectrum, for high risk assets, those would not be able to use for collateral, but they can only use for ordinary lending and borrowing. And with that, I'll pass back to Jane for the competitive advantage.
Yeah, sorry, I think there might be a little bit of lag in my Zoom, but are you guys seeing kind of the competitive advantage slide? Okay, great. So I think just very quickly, right, this slide summarizes a couple of the things that we talked about earlier in terms of kind of our product features and how we plan to differentiate ourselves. So won't repeat kind of what's been talked about, but I think the one I really want to highlight here is the StarkNet community relationship, something that we haven't discussed previously. Beyond the fact that we're going to be the first money market protocol to be there, along with the StarkNet guys when they launch their layer, we really see ourselves as kind of one of the anchor protocols because number one, we're deeply rooted in the community, and we kind of see our success tied with everyone else's success. And what do I mean by this is, people aren't gonna know about zkLend unless they know about StarkNet. And similarly, people aren't going to come onto zkLend, borrow some money, and then get back onto layer 1. The idea is we want a thriving ecosystem so that they borrow some money on zkLend. Maybe they go on a DEX to trade some stuff. Maybe they go mint some NFTs and they go play some games. But the idea is layer 2, StarkNet is kind of the place to be. So with this idea in mind, I would say it really defines kind of the way we see things and the way we interact with kind of some of our counterparties. And what I'm very proud of is I think we take a very community aspect in all that we do. And I want to point out a couple of examples. So on the tech front, John, who is our tech lead, he's pretty well recognized in the StarkNet ecosystem. But basically one of the things that he's done is he's built the entire StarkNet library in Cairo for devs to use. So basically it's a bunch of tools that he has built for himself, obviously as he's building zkLend, but these tools are also enabling other devs to build as they're creating other protocols on StarkNet. Another example on the business side that I want to bring out is we are speaking with another DEX on protocol to protocol lending, as we do anticipate margin financing needs on their end. So I think when we spoke with the Moonbeam guys, I thought like they put it very well, which is, you guys will amplify one another, and what they have seen in the ecosystem is when money markets and DEXs come together, you guys basically amplify impact on one another. So it's very much like we do want to take kind of a leadership position within the StarkNet community. And as we build out in the long term, as the ecosystem grows, we do expect ourselves to be one of the anchor protocols. So with that, let me pass it on to Emma to talk more about roadmap.
Perfect. Thanks, Jane. So it seems that a few things have already been mentioned here, but I'd like to quickly just go through two main things on this slide. So the first is actually our staggered approach to building out Apollo and Artemis, and the second is the exact details of our go-to-market strategy in the short to mid-term. So regarding the staggered approach, you can see that we have Artemis testnet in Q2 22 and then Apollo testnet in Q4 2022. And the main reason for this is mostly the idea that our bread and butter will be first DeFi retail. And the main idea is to really create that mind share and create that brand that we want to really go for. And the second point is actually, this allows us more time to really understand what institutions want when they use Apollo. For example, when they use Apollo, do they just want to generate extra yield on passive crypto holdings, or do they want to practice onboarding, perhaps dip their toe into digital assets for the first time? Or alternatively, are they actually seeking more exotic alpha using ZK Lend as just one of the many DeFi primitives on the StarkNet ecosystem? So again, I'd like to highlight that, our understanding of institutions aren't just FIs or hedges, but also family offices or SMEs, basically anyone who might need a compliance solution on top of a DeFi lending platform. So getting into the actual details of the go-to-market strategy on the DeFi retail side, in the short to midterm, we'll be looking to build out our online presence. And this means not just Twitter and Medium, but also creating, educating and thought leadership content for the community to really educate people why decentralization matters, why ZK, why StarkNet. And as Jane mentioned, our sort of existence and our health is tied very intimately with other StarkNet builders on the ecosystem. So we're thinking AMAs, our Discord and Telegram channels, and even collaborations with other KOLs and influencers and community builders in the space. And actually, even now, before we fully started, we're actually starting to see some really interesting community chatter about ZK Lend already, whether this is community-owned direct ZK directories or StarkNet's ecosystem based Twitters, and it's actually pretty cool. And as a more concrete example, we're actually working with the StarkNet development community to present ZK Lend to the community over there. And the idea behind that is to really connect the business and tech side, because often you find that there is a bit of a divide, and you can provide a very superior product technically, but without the sort of marketing awareness, it kind of we need both of those two parties to really come together and create a meaningful ecosystem. And then I guess on the institutional side, in the short to midterm, I'd just like to highlight three main points. The first is that we're actually expanding. We're working to expand our team to include an investment manager and a compliance architect. The second is that we're currently actively talking to different institutions with varying levels of crypto comfort to really gauge what they need and define the Apollo build out. So for example, we are talking to family offices, a VC crypto native company, and a large payment infrastructure provider. And the last payment infrastructure provider is less so for direct synergies, but more so for tapping into their user base and acquiring new business relationships on that end. And the last thing for the go-to-market strategy on the institutional side is that we're connecting with our advisor, David Lighton, and we're very fortunate to be working with him because he's actually very familiar with the regulatory landscape in the US, and we're actively talking to him to connect us and unlock a lot of new opportunities and relationships. So that's really exciting.
I'll cover the liquidity management strategy really quickly. We will have short-term and long-term strategy depending on the cycle we're at. For short-term liquidity strategies, we'll use liquidity mining, retroactive airdrops. And because we are coming onto StarkNet with all the other dApps all together, so we will introduce bridging incentives to bring more users and liquidity from L1 to L2, and also working with other dApps across the ecosystem to have promotional boost rate or discount borrowing rates so that we incentivize more activity across the ecosystem itself. Lastly, we'll use PCA bonding scheme where we own our deposits, use the income generated from deposits to incentivize more borrowing, and also to redistribute to token holders and also to burn the tokens, so that we keep the supply of the token deflationary, and also to make the price stable.
Yeah. Great. So let me very quickly go over tokenomics. In the interest of time, I'll keep it very short. So I think a couple of key points to highlight here. I think the tokenomic structure is pretty clearly displayed, but I guess I want to give you guys a couple of updates in terms of what we're doing right now. Brian, Emma, and I are actually out and about doing a lot of our fundraising activities and really just trying to we are in the tail end of our fundraising round, so really just talking to investors to kind of understand, how they think of StarkNet and how they think of us building the first money market protocol in the ecosystem. And we are planning a public sale sometime probably in Q2. And the idea is just really to give our investors a little bit more liquidity. But I think not too much really to go over on the tokenomics slide. So happy to move on to the team slide. So in terms of the team, there are currently 8 of us working on this project full time. So you've met Brian, myself, as well as Emma. There's also Jonathan, who's our other co-founder and tech lead, and he's really spearheading all the tech efforts. He on the ZK Lend on the ZK Lend bit, and we do have plans to expand our tech team further. We are looking to hire 2 other devs, so in total, this will bring the tech team to 6 people. So that's super exciting. And as Emma had mentioned, or Brian had mentioned, we are also looking to hire an institutional salesperson as well as a chief compliance architect. So within, I think, the next 2 or 3 months, I think we will really go from an 8-person team to probably a 12-person team. On our advisor side, I probably won't go into too much detail, but we currently have 4 advisors, and they all kind of bring different skill sets. David brings kind of his regulatory/advisory regulatory and legal kind of knowledge to the table, while Kevin, who is a co-founder of Linear, really helps us with daily operations and really just advising us on people management. And lastly, Adrian on community. So I would say we all come from very, very different backgrounds, but very fortunate to have really put together a team that I personally think have skill sets that really complement one another. So I will pause right here, and I'm happy to jump into any questions you guys might have.
Hey, thanks so much, guys, for walking through everything. Curious, I'm somewhat embarrassed to admit I've actually never used StarkNet. What is the UI or UX you guys are imagining for interacting with the protocol from a retail perspective? Is there bridging involved, etc.?
Yeah, I can take this one. So basically, StarkNet is building, like Starkware is building the bridge from L1 to L2. So ideally, if you were an L1 user and you want to try StarkNet out for the first time, you would actually have to bridge your assets over, unlike StarkX. And after you bridge your assets over, it would function like any other kind of layer 2 or any other network where you're actually able to access the different dApps that support StarkNet.
Yep, that makes sense. So the bridge is the third party, obviously by Starkware itself, and then we navigate over to your protocol. Got it. Thank you.
Just one more point to highlight is StarkNet actually mainnet has not launched yet. They are kind of in testnet/testing mode, so they are looking to launch in the next 2 months, I would say.
So I have a question. So can you share why you guys choose StarkNet versus other layer 2 solutions like Arbitrum or ZK Sync?
I can take a stab at. Why don't I start with kind of why within ZK Rollups why we chose Starkware, and then happy to also go into kind of optimism versus ZK Rollups. So or actually, I'll do it the other way around. So I guess there are 2 types of layer 2s, right? There's optimistic rollups and ZK rollups. And for us, we felt that ZK rollups were really kind of the most elegant solution because not only are you submitting the transactions onto L1, but you're also submitting mathematical proofs that go along with it. So there's no dispute period, right? Because the proofs are basically backed by math. So there is a finality in terms of what you're submitting that comes about almost immediately after the transactions are batched and submitted. I think with optimistic rollups, that's slightly different. I guess with the word optimistic, right? Your transactions are batched and sent to L1, but there's no finality because there is a 7-day dispute period. Now, as I understand it, for a lot of the optimistic networks or optimistic rollup networks, these networks actually foot the bill for you, right? So if I'm a retail user and I'm using optimistic rollups and I make a transaction, there is some sense of finality because technically I'm still able to retrieve my money on L1 almost immediately. But technically that network actually takes on the risk because if someone were to go in and say, hey, I'm disputing this claim, the finality of that transaction can be disputed. So I think this is why we believe like ZK rollups tend to be the more elegant solution, even though there's I would say it's a little bit more difficult to get around because their networks tend not to be EVM compatible. In terms of why, like specifically Starkware versus the different ZK rollup layer 2s, there are a couple in existence that I'm aware of. ZK Sync, Hermes, which is acquired by Polygon, and there's one in Beijing that I don't remember the name. But the reason why we're going with Starkware is because they're going to be the first to go to market with a general purpose L2. ZK Sync is at 1.0 right now, and we do anticipate they will come out with a 2.0 very soon. But they will probably come behind Starkware. So when and if the time comes, we would also look to port it over.
Okay, thank you.
Yeah.
Can I ask you a question?
Yeah, of course.
Yes.
All right, thank you so much. So thinking about your, the long-term potential, I have 2 questions. And the first one is, I know that, Immutable X running on the Starkware, then is there any other, L2 chain running on the Starkware? This is the first question. And the second question is, will Starkware planning to issue their own token? That's the second question.
So
Let me see if I get
could-
the first. Okay, sure, go ahead, Emma.
No, I was going to say, regarding the token question, Starkware, if you go on their Discord, they have a very strict, like in all the podcasts that they do, they don't really comment on that. So I think if you want to but they do have a little space in Discord for that. So if you want clarification, I would say go there. But their official stance is always no comment on token.
And can I understand your first question a little bit more? It's you're asking, other than Starkware, are there any other CK rollup platform that's is that the question? I couldn't quite catch it. I'm sorry.
So Immutable X is a live project on the Starkware, right?
Right.
And in it, is there any other like project live on Starkware?
Right.
Those,
Yeah. Right. I think other than Immutable X, there is UIDX that's actually using the same technology as Immutable X using StartX, and they have been, operation for quite a while, and then they're actually quite a big deal because in 2021, their actual trading volume was over Coinbase for momentarily or reaching it. So it's really a milestone for the DeFi space in terms of trading, and in terms of the number that they're looking at compared, using the CK rollup before and after, in terms of transaction fees, it's 0.1%, and then for the transaction speed, it's about 3,000 times faster. So with that, I think we do see that the StartX technology is actually, or the CK rollup behind it, it's really powerful, and we're so excited to see there's a general purpose StartNet solutions coming on board.
Okay. Thank you.
No problem.
So besides Alameda, who are the other investors in the project so far?
Yeah, we have a couple. I think just a heads up, because our round isn't fully finalized. So these are verbal commitments. We'll preface it with that. In terms of kind of investors, there are a couple we're very excited about. Obviously, there's Alameda, there's Starkware themselves, and I can't help but tell the story. But basically, the only reason Starkware started looking at us was because John, who is our in-house dev, was so talented, and he really contributed to the ecosystem that the CEO called him out and was like, "Hey, what are you building?" And I think that really shows, like, that really is a testament to the strength of the project. We also have Delphi, we have CMS, I'm trying to think, DCVC, Lemnis Cap, GBV, and I would say a couple more that we are waiting on. But I think overall we're quite excited, and the book is at 3x oversubscribed, so we're very grateful for that.
Thank you, guys. So do we have any further questions for ZK Land? Okay, thank you so much, Brian, Jane, and Emma. Thank you for the presentation. And also thanks, Brian, for bringing the team over to present. So let's move to Thomas.
Great, we'll hop off then. Thanks a lot, guys, for the opportunity. And feel free to telegram us, Jane_ZKLand, Brian_ZKLand, Emma_ZKLand, if you guys have any further questions.
Thank you.
Thank you.
Thank you very much, guys.
Bye.
Thank you, everyone.
Eva actually has a question for you guys.
Oh, ooh. Okay, I see it. Let me.
Yeah, when again do you expect to go live?
Oh, okay. I'll take this since I think most people dropped off. We are obviously there are a couple of dependencies before we can go live with StarkNet having to launch, but we are expecting to go live with testnet in Q2 and then mainnet in Q3.
Okay, thank you.
Thank you. Bye.
Thank you. Bye.
Thank you, guys.
Okay.
Great. You want me to just jump right in, Sherilyn? Or any?
Yes, please.
Great, will do. Cool. One moment, share screen. So as you guys might have seen, I am covering Abracadabra, but it's a new version of, or it's a kind of a new product, I guess, that they're launching, and a new related strategy. So I would imagine that most people on this call are familiar with Abracadabra, but just to give the 5-minute overview of kind of the basics of what they are. Start anew. Basically, what Abracadabra is a protocol that allows you to borrow against interest-bearing tokens. So if you have your Yearn Vault tokens, your Curve tokens, are, I don't know why my internet's not working. Here we go. You can come here, deposit those interest-bearing tokens, borrow MIM, which is a stablecoin, and then go use your MIM elsewhere to do things. As you can see, it's limited. I mean, they say and more, but it is limited to a certain subset of yield-bearing tokens across Sushi, Yearn, etc. And then, that's really great because one thing that this does, it feels a little like Alchemix in that regard, in the sense that you can essentially borrow against those assets and effectively pay down the loan over time with the interest if you'd like. However, the fact that you can take your MIM, your magic internet money, and go elsewhere obviously gives you the ability also to, as the risk increases as you kind of stack up the yield farms, but you could still do that and go basically lock up your staked ETH, lock up your USDT, etc., earn the interest, come here, borrow MIM, go do something else, go buy a car, whatever it is you want to do. So what I did, and sorry, so that's the basic, right, Abracadabra approach. The approach that I want to cover today, however, is a new product, I guess it's called, of theirs. It's called Degenbox. So what's interesting is Degenbox is actually built on top of BentoBox, so they're licensing it from SushiSwap, and what they've done with their instance of BentoBox called Degenbox is, and it's actually was part of the reason I was asking about bridging with the previous team, is I think probably most, again, people on this call are aware that Anchor Protocol over on Terra earns 19.5% or something like that. It's a very good return for a stablecoin in just a kind of a one transaction single asset staking model. However, obviously you have to bridge, you have to do all of that. So what Abracadabra and Degenbox does is simplify that entire process and you're able to effectively, at the highest level, deposit your UST. They bridge it automatically over to Anchor, over to Terra, deposit it on Anchor. They earn that percent, and they give you 16.5%. And obviously, the extra 3% kind of gets eaten up by cost and margin for the Abracadabra team and protocol. So, point being, it's a very simple approach, relatively speaking, for Aladdin DAO and or anyone else to go deposit UST in the Degenbox and earn 16.5%. So it's effectively a stable coin. You're earning a really solid return, and then at the same time, you do have the ability to borrow your MIM, your MIM, which kind of frees up your capital, at least partially, because obviously you probably don't want to. I don't think it'll allow you to take out 100% collateralized loan. However, you can obviously pull some of that money back and then still have access to that capital. So that said, let's quick run through kind of the process of what it looks like. And it's again really simple, and then you can kind of continue to stack complexity on top of it if you wanted. I don't think, given kind of the like broad governance and just community constraints that we put on the strategies for Aladdin DAO, that it makes sense to start going riskier and riskier. But for individual users who have a higher risk tolerance, obviously that's completely possible. So you have to go acquire UST, of course, but then you deposit them into what they call the cauldron, which is just their UST lending market. And so you deposit those in, and actually I'll run through these steps really quick and then show you the diagram. Then basically in an automated way that's not seen by the user, Degenbox, the licensed bento box within Abracadabra, bridges 85% of that over to the Anchor protocol on Terra. 15% is left on mainnet, just to guarantee smooth withdrawals and kind of provide liquidity on mainnet. And then Anchor is obviously earning, it produces the AUST, which is their interest-bearing token, and it obviously represents the underlying asset of UST. And then once a week, Abracadabra sends part of that AUST back to the Degenbox. And again, you're effectively earning that, and then the AUST provides some liquidity on mainnet as well. So at a kind of a little more detailed level, this is really what it looks like. So as a user, this is kind of the starting point. You can lend USD, goes into the cauldron, which is just part of Degenbox, as I understand it. Then 85% of those assets get bridged over to Anchor. AUST earnings returned to the cauldron, and then the user, this is all kind of happening in the background over here. User can borrow MIM, and then they can also go off and do other things with it, right? You can go lend out your MIM, you can swap it, you could LP it, etc. You can get a decent decent rate on Curve, I believe, still with your MIM. So that's really kind of the simplified view of what's happening. And then of course, as soon as you want to repay your loan, you receive your UST collateral back, plus the interest that you've earned based on the time that it was in Anchor protocol. The risks here for Aladdin DAO, I think this is an interesting one, because I believe, and Sherilyn could correct me if I'm wrong, I believe at one point we had kind of as a group decided to stick with ETH mainnet plays so that we didn't involve bridging directly, and also particularly because of some of the technical limitations of integrating with other projects in that manner. And that was quite a while ago, so it could have changed. However, this is a cross-chain play where you're not actually having to bridge anything, at least as a user. You're able, it's all happening in the background. Which is both a risk and I think a plus in regards to the return that's being generated. There is, if we were to move large amounts of capital in, there's some limitation. Obviously, there's a natural cap to the amount you can withdraw at any given time, just because the majority of the capital is over on Terra. And then Yeah, and then this is actually not a limitation risk. I put this in the wrong section, but because it's stables, there's a low probability of being liquidated, which is great. Price fluctuations are obviously very small. So it's a very relatively simple strategy to propose, but I think given the return profile and the risk profile, it would be a solid fit for the DAO. And then I can show you guys, I deposited a whopping 105 UST. This is just what it looks like when I'm about to remove it, just to give you a sense. You can see I can borrow up to 86 MIM still, given the liquidation. And just, yeah, I mean, you guys can, I don't have to walk through all of it. I'm earning 16.56% on my UST. And again, could go do something with that MIM that I have access to. So I'll pause there, open up for questions. Happy to chat through it.
Thank you, Thomas. I think it's very hard to borrow from Degenbox these days, right? It's very.
You said it's hard to borrow?
Very hard to borrow. There's very little room to borrow.
Yeah, there is exactly. They cap it, and basically it's, to your point, if this is, I think, what you're getting at, because there's so much interest in their cauldrons, you basically are waiting for, like, on the Abracadabra side of the house, you're waiting for like their risk tolerances or people to pull out their position so that you can then get in. They're like basically hitting their caps. Yeah. So that would be definitely a consideration that I didn't note. Yeah, I mean, I was obviously able to do this position, but it's incredibly small considering.
Yeah, I checked a couple of times, but it's always like 0.
Oh, really? Okay. Well, that's good to know. And considering Aladdin, maybe that's a deal breaker, unfortunately. I also can imagine there's got to be a copycat coming soon, considering the fact that it's capped. There's clearly market demand that's not being met by Abracadabra. So I wouldn't be surprised if somebody forked this and hopefully opened up another market.
Yeah. What actually determines the cap at the back end?
I believe it's because, and this is, so forgive me, Abracadabra team and everyone out there if this is incorrect, but I believe that it is because you can leverage a position, and I don't think I can, let me see. Yeah, so you can, if I was going to go, kind of do a new transaction or just change my current position, I think is possible still. This is effectively what it would look like, right? I'm here at the borrow page, of course, in the UST cauldron. You can actually lever up so that, let me see. Okay, this is a different UI than what I was playing with yesterday. But point being, I think to answer your question, it's the fact that they have leverage. So there's X dollars obviously deposited into the protocol, and then people are levering up and borrowing against that. And I believe that's exactly the reason that you hit a cap, because they obviously can't over leverage based on the amount of assets in their cauldrons or in their vaults. I don't know exactly what they're thinking and what the math is in terms of why they don't, accept more collateral and then they're able to offer more leverage or able to offer more loans so that more users can borrow at a higher, borrow more assets. So, but they're kind of creating that cap, or the protocol is creating that cap, as I understand it, because of that leverage. It's basically the risk profile being generated by the protocol and ultimately by the team.
Yeah. As long as they can liquidate the collateral, it should be okay, right? The risk should be manageable. And UST actually, is quite liquid. It seems to me that the cap they set is, relatively small, right? Compared to the liquidity USD has in the market?
Yeah, I mean, I completely agree. We actually looked at UST a little bit and just, tried to run through basically a rating of different stablecoins. And of course it came out pretty strong. It's not as strong as USDC and some of the other ones that have been around longer, primarily because of the collateral of Luna, or being backed by Luna. It's slightly more risky than DAI or USDC according to our rubric. But to your point, it's incredibly liquid and pretty battle tested at this point.
Is there any other questions for Thomas?
Hey, Thomas, what's the temperature like right now in Abra? Like I haven't paid as close of attention to its like the whole Wonderland fallout, and there was obviously a lot of there's a lot of fear just because of I mean, I don't know, the whole market was sort of falling apart, and then the whole seafood thing happened, and then there was spillover to Abra because of Danny's involvement. And so, like, do you think the project has recovered from this, or is like that's been my main concern is I'm just worried about what else do we not know about Danny. I mean, he is he's just, I won't go too much more into it, but I think he's completely full of shit. So when I worry about touching a product with someone who has like proven over and over again that he has he's lied to the community. I mean, he's made some incredibly awful judgments, keeping Sifu involved with Wonderland. And yeah, I mean, that's my main concern. I love Abra as a product. I just don't know if I could ever trust putting money into anything that Danny touches now.
Yeah, DeFi Dad, that's a phenomenal point actually, and I didn't even like bake it into this. Yeah, I mean, so I would imagine most folks are familiar with everything DeFi Dad just mentioned. I know there's talk of kind of to your point, the Abracadabra team / product subsuming the Wonderland protocol and product, I believe, is kind of how they're thinking about structuring it, purely to maybe kind of like merging the two effectively to kind of save Wonderland to some degree. I can't honestly speak too well to the community. I haven't had time to like poke around in there and become familiar with the overall sentiment of everybody, both the users and the team, and kind of like you said, what the temperature is. The only thing obviously I could point out is, of course, go figure, money talks, or whatever the phrase is. So to Sherilyn's earlier point, they're certainly still kind of maxing out on the protocol side. So the demand is there, obviously, broadly speaking, and this is very much painting with a broad brush. In terms of looking at the like metrics of Abracadabra as a protocol, it looks like it's not very affected by all of it, just given the amount of capital in there and the way people are using it. But that's a good point about Danny and everything, and especially like you're obviously I guess one of the higher profile folks on Aladdin DAO. So if we ended up not wanting to go this direction, particularly because of that kind of team risk, as I would put it, like I would actually completely understand and would be happy.
Because this strategy, I was actually trying to get into that strategy beforehand, and I'm like looking right now at the amount of money in Abra over the last, like, just looking at it over the last year, and it looks like, I want to say that maybe, by the way too, I'm ignoring like the volatility of the prices of all of the volatile tokens that would be deposited in there. But if I'm measuring based on like USD, it looked like it dropped by about 50%, which is consistent with what happened within the market. I mean, everything sort of dropped 50%. So I think it is fair to say that if we're just looking at the amount of, if we're looking at how money talks, it's clear that money hasn't really, money is not leaving Abra. So it's been such a strong project, and I think we should keep a close eye on it because of the really like the easy high yield that there is to earn. But I definitely would just have some fears about, or I would have some fears that could easily be addressed if someone's able to determine at the smart contract level that, the funds and the contracts that control those funds is controlled by a multi-sig, and that multi-sig is, has signers that are not the same person signing from another address. I've never been as paranoid about that, but and by the way, I had no money in Wonderland, so I didn't lose anything to be like burned by it. But just watching it from afar, I mean, a lot of people clearly got hurt, and so that's it. I think that like there probably could be some more research done, but it's gonna probably require someone who's able to look at the smart contract level to determine, like what is this truly like a decentralized protocol, or is this something that is controlled by just a few people? And if it's controlled by a few people, I would definitely caution anyone to put money into it. But but this is a great presentation, man. I mean, not to get too down on Abra, the protocol, but I recognize that like protocols look a lot like Web2 startups. They tend to have, some sort of like iconic founder, the ones that do the best. And for a while, Abra did so well because of the praise for Danny. I just don't know how like any project is going to recover after like what happened there. But, again, there's a lot of money in Abra right now that seems like it's sitting there and not moving. So I guess we'll see.
Yeah, and I hadn't done this ahead of today, but I'm glad you're bringing it up. So no harm or no worries at all. But it's interesting. I was looking for an audit in their docs, and you can see that they have this difference checker, I guess, between the Kashi's and another sushi product or protocol, and then they say, great, here's the audit but the audit's for bento box. Whoops, here. So they reference an audit, but it's an audit for sushis. And then they just say,
and this is kind of consistent with there was obviously a lot more that was coming out many weeks ago with just lots of like inconsistencies in what we understand about these projects by Danny. But I'm somewhat hopeful just because I have quite a few friends who have who have really been excited about the possibility of MIM being like a lasting decentralized stable coin. So at end of day, like if you use that Degenbox, I mean, for those that were earning like 100% in terms of yield, I mean, I can understand why they took the risk. But if you're not able to earn that yield, or if you have questions, for a while there too, we were all worried about the UST and the anchor rate continuing to pay out. But that is one thing that I believe has been addressed. They replenished the anchor reserve. So I don't have worries about, the sustainability of the anchor rate anymore. It's more about what might we not understand about what's happening in Abra. So what I'll do too, I actually have a few friends who should be able to answer some of these questions and let me know if like, yeah, I've looked into this at the smart contract level. So I'll reach out to a few of those folks and see if I can get any answers for us.
Yeah, cool. Yeah, if you end up having any, mostly out of just my own curiosity, if you end up having any convos, would love to join you, frankly. Just because.
Yeah, absolutely.
Yeah. Cool. Carolyn, I'm just seeing that we're 2 minutes out, so I'll kick it to you unless there's other questions.
Yeah. Thank you, Thomas. Thank you for the presentation, and thank you, DeFi for the comments. And I think we just have to know the most important thing and everything, right? And if we want to place, big dollar into a protocol. I think it's coming to the end. Just a couple of housekeeping items. So we have this vote for the Boule members who help most to build Aladdin community going on. So please make sure you participate in this voting process. So we'll have like one vote every 2 weeks. So last week we had DeFi Dad, Jason, and I think VFAT, right, got the rewards. So the new vote has been posted on Snapshot for this week. And next week, we're going to have Nick Pai and Sunil to present, as both of them are on West Coast. So we'll start the next meeting 1 hour late. And just, a heads up on a new product. So since we launched the bonding and staking model, right, to help to enable the Boule Council to manage the treasury, we haven't got really positive feedback on the bond sale, given the legacy token issues for V1 and also the market headwind. So the team have been working on a new product, try to capture the value created by the Boule Council, and we will be able to share more details around this next week.
That's awesome. Looking forward to seeing that.
Yeah. And and thank you everybody for your time. And so if no further questions, let's talk next week.
Cool. Thanks all.
Thank you, guys.
Okay, thank you.
Bye.
Thanks so much, everyone.
Thank
Bye,
you,
guys.
Okay, bye.